Ladies and gentlemen, welcome. Today the topic is Chapter 7, and Chapter 7 deals with the legal concept of legal forms. As always, we're going to mix law and business, and we're going to take as a starting point the legal concept of legal forms, and we're going to link it to the business elements which are related to the specific dimensions, the legal dimensions of legal forms. In essence, the situation is the following. Law makes legal forms available to legal subjects, people, companies, in which you can run a business. Now, the law offers you choices, but as with any choice in life and any choice in law, choices have consequences. So this lecture will introduce the various legal forms to you, the differences in the various national legal systems, and will make you aware of the variety of consequences which follow from you as an entrepreneur choosing a specific legal form to run your business in. When we introduce legal forms to you, it is maybe handy if you see it visualized. Here you see a circle, and the circle reflects what law makes available as legal forms. And within that legal form, you, the entrepreneur, can run one or even more businesses. National legal systems will make legal forms available which are designated with the names that jurisdiction uses to indicate what type of legal form the business is using. Yet, there are basically in the world, in the legal traditions of the world, three types of legal forms available to run a business in. The sole proprietorship, as you see here, the partnership, and the private limited liability company form. A sole proprietorship is rather simple. It is one human being, one legal subject who runs a business, and that business is not separated from his private assets. A sole proprietor mixes private and business property and private and business liabilities. So there is basically, from a legal perspective, no distinction between the human being running the business and the business as such. It gets slightly different when we talk about the partnership. A partnership is like a sole proprietorship, but it is two or more legal subjects, two or more human beings which run a business. And here we have the situation that we have a partnership and two or more legal subjects. In principle, legal systems make a difference between the property and the liabilities of the partnership and the property and the liabilities of the people running the business in the form of the partnership. Now, the situation in legal systems is different, but the situation may be that creditors of the partnership can take recourse on the partnership property, and if that turns out to be insufficient, they can move towards the private property of the partners to get recourse for what they are entitled to by selling private property of the partners and use the proceeds to settle the debts. The third generic legal form available is the so-called private limited liability company. This exists, this legal form, independently of people. And here we only have one legal entity, which is in itself a legal subject. And that legal subject, that legal entity, has its own property. And with that own property, it provides recourse for its liabilities. And the people running the business, as such, are not, in principle, liable for the debts, the liabilities, what they do as management of the private limited liability company. So here something came into existence by law which participates in business and is able to contract, to sue, to buy, to sell, the private limited company can in principle act as if it was a human being, although of course some things which human beings can do are not available for the private limited company. Think about marriage. But from the perspective of business, it is by law made identical to people running a business as a human being. Here we are at a slide which introduces us to an overview of the legal forms. What we're going to do on the next slide is to look a bit more in detail on the various legal forms which are available in most of the world's jurisdictions, although of course they have different names in different jurisdictions. As we are in the European Union, we also look at that dimension, but that is something we will only do now and not in any more detail in the rest of the lecture. The main difference, the main distinction at the level of legal forms is the distinction between natural persons and legal persons. That distinction is made at a national level. If we look at the EU, we will only find legal forms which are legal persons, but as said, that will not be dealt with in more detail. Now focus on the national legal persons. We briefly discussed ownership, and there you see between brackets or parentheses, you see partnership, partnership under common form, and limited partnerships. Those are different forms of the partnership, whereby the partnership is generally a collaboration between professionals like accountants and doctors. A partnership under a common firm is the legal form used for business cooperations, people who cooperate based on a contract to run a business together. And we see the limited partnership, that is a partnership which also has partners which are not active, but only supply financing and in return are rewarded with a share of the profit. So it is like a partnership under a common firm, but there are silent partners who finance. When we look at the legal persons, and we will deal with that, you see the arrow in more detail, we see on top the private and the public limited liability company. That is what we will focus at. In the book, but not in the lecture, you will find more information on the association, cooperative, foundation, and limited liability partnership. On the last, a few words. The limited liability partnership is a partnership in which the partners have limited liability, so they are not liable for obligations, debts, or any other liability of the partnership. That legal form is a typical Anglo-Saxon legal form, which, for example, in the Netherlands does not exist. Why were the partnership in brackets? That is what we will explain to you in a few slides down the road. First of all, let's look at the characteristics of legal person. As already said, they exist, and they exist independently in business as a separate legal subject. Because they exist independently, they can own assets, property, intellectual property, they can contract, they have their own liability, and they can sue another human being, natural person, or another legal person. The characteristics of the two we focus on, the public and private limited liability, is that they are incorporated, so you have to go through a process to create them, and part of the process is that shares are issued by the legal person, and those shares are sold to shareholders, and the money made with the shares is used for financing the legal person. At incorporation, one of the steps is that articles of association must be drafted, and that document outlines important decisions like the number of shares, the value of the shares, and it will appoint the management. Because, and that is the next step, a characteristic of the legal person is that it cannot act by itself. It is an entity created by law. So you need human beings to act on behalf of the legal person. That is referred to as delegation of authorities. So the legal person has its own authorities. It can in principle do what it wants, but it cannot act. And to act, it requires people, directors, which are appointed by the legal person to act on their behalf. So that is, maybe a bit difficultly, explained what delegation of authorities refer to. A board is created and the board acts on behalf of the legal person. Now, the legal person has shareholders. Those shareholders are the people or the companies who bought shares at the incorporation or later by buying it from other shareholders. Shareholders are in a relatively comfortable position from a liability perspective. Shareholders are not liable for any obligation, debt of the legal person. That is what the limited liability in the name of the legal form refers to. The legal person is 100% fully liable for its own debts and liabilities. The shareholders can only lose the value of their shares. Now, the law considers the shareholders as the owners of a limited liability company, which means that important rights are given to the shareholders by the law. Now, this is the overview. Forgive me, I will make a sidestep towards the Netherlands. This is in Dutch, but I'll explain it in English. The sole proprietorship is in Dutch named eenmanszaak. We bring in now, for the moment, also the tax dimension. In the end, we will all integrate it, but for the moment we pick certain dimensions and we move towards a picture with more and more details. A sole proprietorship, hopefully, makes profit. That profit is taxed, and it is taxed by the Dutch income tax. De partners in een maatschap, een vennootschap onder firma, or a commanditaire vennootschap, are in principle also human beings, however, cooperating for business in a legal form. But as the partnership is not a legal person, they are taxed just like the sole proprietorships by income tax. It gets different when we talk about the private limited liability company, of which we have in Dutch de besloten vennootschap and the naamloze vennootschap. The profit of this legal entity is subject to corporate tax. And if the legal entity distributes dividend, profit in the form of dividends to its shareholders, that dividend is subject to a dividend tax. On the other hand, there is also salary tax, and that salary tax is levied on the salaries which are paid to the directors and to any other employee. The people who receive their salary must every year make an annual statement to the Dutch tax authorities. In that annual statement of their income, it is taken into account that they already paid salary tax. But if they have, for example, other sources of income, or if they have tax-deductible interest paid for a mortgage on their house, that changes the whole tax picture. And the income tax is, let's say, the final picture of all their earnings, taxable earnings in a given year, and the income tax then ultimately is decisive for what they get back because they pay too much, or what they additionally have to pay because they paid too little tax, too less tax. That is the situation. And then we should realize the following. In the overview of generic forms, the partnership was between parentheses. The reason is that at the moment of writing the book, it seemed that at the 1st of January of this year, it would have been possible for partnerships to acquire legal personality. But as so often, the law can be very slow, and at the moment the proposed Act of Parliament, which would enable partnerships to acquire legal personality, has not yet gone through the voting process in the Dutch Second Chamber. What were, in a nutshell, the changes? Legal personality for partnerships and the use of the word vennoten, the designation vennoten for what is now maatschap en vennootschap onder firma, and the so-called silent partnership, commanditaire vennootschap, would remain in existence as it is, yet with the opportunity to acquire legal personality. Dutch law has in its Book 2 of the Dutch Civil Code, and that Book 2 deals with the rules for legal persons, some general provisions, and those general provisions apply to all legal persons. What we're going to do is to show you a few of them, just to illustrate to you how the principles of legal personality, as we have just discussed, are reflected in Dutch corporate law. In Book 2 of the Dutch Civil Code, we will find in the very beginning a list of the available legal persons, the choice made available to you as an entrepreneur. But as said, we will focus on two legal persons, which in English are called open corporations, in Dutch naamloze vennootschappen, open because the shares are freely tradable, and closed corporations, besloten vennootschappen, closed because sales are generally subject to sales restrictions. Now, one of the characteristics of the legal person was its independent existence. That is reflected in Article 5 of Book 2, which explicitly states, as far as it concerns the law of property, and that means property law and also contract law, a legal person is equal to a natural person, so it can participate independently in business. However, we also see the character of civil law reflected in Article 8, in the sense that all involved in a legal person have a statutory obligation to behave towards each other reasonable. Now, that is indeed an open norm, but the second paragraph of Article 8 clearly states that when not acting according to that reasonableness requirement, it may make certain decisions, regulations, internal regulations, void, in the sense that they will not have the desired effect. The principle of delegation of authority is reflected in Article 9 of Book 2, because it imposes a responsibility on the director, he who received the authorities, which are in principle legal persons' authorities. Each director must perform his tasks properly, and that is a relationship which the director has with the legal person. If he would not perform his duties, his tasks properly, it may lead to liability towards the legal person. In principle, each and every director and all collectively have that responsibility. They can only escape it if they could evidence that they are not gravely to blame for it, the second paragraph, and if a director can evidence that he has not been negligent in taking measures to avert the consequences of his or the whole board's improper performance of duties. Well, some of you may want to become an accountant, so for them Article 10, which clearly states that the board of directors has a liability in the sense of keeping proper accounting records. And finally, in Article 391, we see something peculiar. The government is given the opportunity to create additional requirements by an order in council for the annual report, and that order in council has been used to impose on stock-listed companies the obligation to apply the Dutch Corporate Governance Code. The little ball you see there is the symbol which represents the Dutch Corporate Governance Code. However, that has, as we will later see, a comply and explain principle, but the article is included because it's peculiar in the sense that self-regulation, the Dutch Corporate Governance Code, is developed by company directors privately, that self-regulation is imposed on stock-listed companies by giving the government the authority to choose a code, and they have chosen this code, the Dutch Corporate Governance Code, as being applicable on stock-listed companies. Let's now go through roughly the various dimensions of legal forms. We have said a few times that you as an entrepreneur, allow me to address you in this way because most of you will be business students, that you can choose a legal form to run your business in. But an interesting question is, of course, what are the consequences of the choice? So the consequences and the other dimensions which are relevant are listed for the various legal forms on the next slide. Above, you will find the generic legal forms as discussed. What are now the dimensions which you should take into account if you would like to evaluate which legal form is best for you? First of all, is it difficult, expensive to create the form? Sole ownership is rather cheap, partnership only requires a contract, it need not even be written in general, and the limited liability, you have a bit more complicated incorporation process. Now, internal, the question is who can make decisions. An important element is who can represent, act on behalf of the legal form. What's the liability situation? Financing dimensions. Who owns which property? What is to be done with the profit? What reporting obligations are there for each of the legal forms? What tax regime applies to the profit? Can we easily, or how otherwise, transfer the company in that typical legal form? And what is the situation with respect to bankruptcy? Those are all elements which will play a role in your decision, although the decision can also be summarized rather simply. If you're small, do not run a lot of risk, do not have too much money, a sole ownership is the best option. If you cannot run the business on your own and you would like or must cooperate with others, and you're still small and simple and there's not too much money involved, go for a partnership. And if you want to look professional, or if the business grows quickly and has a substantial profit in the hundreds of thousands, and it comes with a potential risk of substantial liability, then you should simply go for the limited liability company. Now, that is in a nutshell what the dimensions of each of the legal forms are. The course and the book take an international perspective, and in order to make it a bit realistic, we sometimes assume that you are the manager of the EMEA region. This blue countries reflect the EMEA region. And if you are managing that, and that is the link to the previous slide in which you saw a question mark, you will encounter companies in other countries, in the EMEA countries. Those companies may be a supplier or maybe a buyer, but those companies have a name, and that name is the legal form which is available to them under their national jurisdiction. If you look at this list, you see some examples of basically the same legal form, the same legal concept, but labeled, named, designated completely differently. This should make you aware of the fact that when you understand the principles of legal persons well, it will help you in assessing what exactly that foreign counterpart is. It will also help you in assessing potential risks, and it will simply help you in better negotiating, and it will help you in demonstrating an understanding and respect, hopefully, of the other counterparts' national legal system. So going back, it is there, the names are different, but generically speaking, the characteristics of the public and private limited liability company are to a large extent identical all across the world. Law allows people and companies to create, and we call that incorporate, legal persons. Those legal persons, we saw that in the principles of the legal person, issue shares. Now, the shares of one company can be purchased by another company. That is the principle of holding structures, in which you have a legal entity, a legal person, which holds the shares in another legal person. How it works we'll show you on the next slide. Here we have a mother company in country A, which has chosen a legal form available in country A. It has purchased the shares of a legal form in country B, and because it owns all or at least the majority of the shares, that legal person is considered a daughter of the mother company in country A. It did the same in country C. It incorporated a new legal form as available in that jurisdiction, or it bought the shares of an already existing legal form in that jurisdiction, and it added that company to its holding structure, because the mother is also holding the shares of the legal form in country C. The reason that this type of activities are implemented by usually multinational companies, international companies, are miscellaneous. For example, in terms of liability, each daughter has its own liability. So the mother is in principle not liable for any liabilities of any daughter company. Now, in some jurisdictions, under certain circumstances, that so-called corporate veil is pierced. And if the corporate veil is pierced, that means that the mother company is held liable for the activities or the debts of a daughter company. Another reason may be a fiscal one, a tax one. We know that the Netherlands, at least up till this year, offered attractive opportunities to channel royalty payments to the Netherlands and then virtually tax-free transfer them to another third country with which the Netherlands had a double taxation treaty. So that means that the legal entities which are created in the Netherlands may be created there for the sole reason of profiting from the Dutch tax system. Other reasons to create a holding is that a holding may be considered by a national tax authority as a so-called fiscal unity, one taxable object, which would mean that losses in any of the daughters would become tax deductible in the tax reporting of the mother. Another reason why holding structures are created is that a company may decide to bring all of its intellectual property, patents, trademarks, etc. into a separate entity, thus splitting it off from the mother and ensuring that in case the mother would become liable for anything and would not be able to meet its liability obligations, that recourse could be taken on the intellectual property by bringing it all into a separate legal entity. That risk is minimalized. Then, if you run various businesses, it may be interesting to bring the various types of businesses into separate legal entities, because in the case you would like to merge that business or sell that business, you have an entity which you can sell, while when it would still be part of the single entity, it would be more difficult to split it off or to combine it with an already existing business which you want to purchase. And then last, ISDS opportunities, investor-state dispute settlement opportunities. The Netherlands has treaties with a large number of countries. Those treaties may contain an investor-state dispute settlement clause, which means that a Dutch company, also a reason to incorporate a Dutch company for multinationals, that a Dutch company, if damaged by actions of the government of a country in which it invests, and it would be severely damaged by it in terms of financial damage, that this ISDS clause provides an opportunity to reclaim that damage from the country in which you invested. And Dutch companies can in generally easily do so based on the large number of treaties the Netherlands has with other countries. So apart from the attractive tax system, this ISDS opportunity is also a reason to create a Dutch daughter and then use that Dutch daughter to invest in other countries. Just to show you, this is a picture of what used to be Google and is now called Alphabet. The whole Google business was restructured and there is now one overarching holding, Alphabet Incorporated, and that Alphabet Incorporated holds the shares of all kinds of other holdings and limited liability companies, one of them being Google Limited Liability Companies, and at its turn Google Limited Liability Companies holds the shares in all kinds of other legal entities. Here you see how complicated a multinational company can make its organizational structure by working according to the principles of a holding company. We mentioned the Netherlands, but Ireland also had an attractive tax system, and here we see an article about Facebook. Facebook was channeling all its revenues, or at least the majority of it, from all over the world to an Irish holding company, and from there it went to tax havens like Bermuda, and as such Facebook could avoid having to pay corporate tax in the US. That was subject to increasingly negative publicity, also from the US government itself, and Ireland decided, although it took a number of years for it, to change its tax system, and it has resulted in Facebook now stopping with this tax loophole, and Facebook going towards a situation in which it will pay normal taxes in the countries in which it generates its revenues. The Dutch tax system was renowned for its attractive opportunities for Dutch companies to profit from very low taxes on royalties and interest payments paid from abroad to a Dutch mother. The international criticism on this system has led the Dutch government to take some initiatives. One of the initiatives is that if money flows into the Netherlands from interest payments or royalty payments, that when it is subsequently transferred to a low tax jurisdiction, that it will be taxed in the Netherlands with a so-called withholding tax of over 21.7%. For the rest, we will not discuss this in any more detail because this is tax law and that's a bit outside of the scope of this course. Let's go back to the legal persons and let's start focusing on the core of this lecture, and those are the limited liability companies. Now we know that something has to be done to create a limited liability company. The process of creating is referred to as incorporation. We'll go through that process first quickly and then in the next slide a bit more in detail. This slide provides an overview of the steps involved in creating a legal person. Human beings, one or more natural persons, they go, at least in the Netherlands, it may be arranged differently in other countries, to a notary. The notary will help them in drafting the Articles of Association. That's the basic document which outlines the major decisions made in the context of creating the legal person. And those major decisions are about the purpose of the company, which is referred to as its object, and that is important for the management because it must act always within the purpose of the company. The management will be appointed in the Articles of Association, its authorities defined, and the value and number of shares will be in the Articles of Incorporation. Then the legal person will be created by the notary. It will issue shares which are sold to, purchased by shareholders. The capital which the shareholders bring in flows back into the legal person, and in return the shareholders as such individually and collectively as general meeting of shareholders are entitled to certain rights which are attached to being shareholder and or to participating in the general meeting of shareholders, which must be held at least once a year for every legal person. Now a bit more details. We already saw a few slides ago that you have closed corporations and open corporations. The difference is in the free transferability of shares. Closed corporation, usually limitations. Open corporations, there should not be. and the open corporation is also the legal form which you can use to get stock listed, because you understand stock listing requires freely transferable shares. The Articles of Association were discussed. We very simply said that the management must be appointed, but we will see that the structure of the management, the board of directors, can be one of the two following. We can have a one-tier board and we have a two-tier board, to be discussed later in more detail. The notarial deed comes with cost. For the BV in between 500 to 1500 euro, and for the NV starting from 500 to over 2000 euro. The share capital, we said the legal person must issue shares, but is that subject to a certain amount? The minimum amount for a BV is only 1 cent, but the minimum amount to be issued for an NV is at least 45,000. Now, we see here under share capital authorized and issued. Authorized is what is in the articles defined as the maximum number of shares which can be issued, and the issued shares are the actually issued shares, so the number of shares actually sold to shareholders. Any company, any business, so also the limited liability companies, must be registered at the Dutch Chamber of Commerce, and that registration will include details on the right to represent the legal person, whether the P&L or the balance sheet must be published at the Chamber of Commerce, the Dutch Chamber of Commerce. That depends on the size of the company, ranging from only a profit and loss account to, for big companies, a profit and loss account and a balance sheet. When you register at the Chamber of Commerce, you are automatically registered for the tax authorities and you get a VAT number. And because you are going to be taxed, you must submit to the tax authorities annually a fiscal, which may differ from the other P&L, a fiscal P&L. We mentioned a couple of times the words boards of directors, we mentioned shareholders, and now we go into some more detail into the corporation, and we're going to ask ourselves which authorities and which rights do those people and bodies which are involved in the corporation have. In other words, who are interacting in that context of a corporation, and what authorities and rights should we take into account? In order to understand that, first of all, this picture, which actually reflects the participants in the play. We have discussed the incorporation of a legal person, and that when incorporating a legal person, a management is appointed. That management takes here the central position, and we have already seen that that board, that management, must act proper towards the legal person. So the legal person exercises a kind of control on the management. On the left of the management, we see the Supervisory Board. Not all companies will have that, but it is possible that a special group of people supervises and advises the board, also a kind of control. We have on the right hand side the general meeting of shareholders and individual shareholders. They also play a role in the corporate play, the corporate drama. And finally, at the bottom, we see the Works Council, and the Works Council may also influence the decision-making capabilities, authorities of the board. So these are the persons in the game. They interact with each other, And the question is, of course, how should they interact? And then specifically, how should the board interact, take into account the fact that there are more stakeholders in the company than just the management itself. In order to do so, we'll run through the various participants in the game, starting with the shareholders, and then we will look at the management, the liability of the management, the supervisory board, and finally the works council. Let's develop our understanding of how the legal person functions by first looking at shareholders and general meeting of shareholders. Those should be distinguished from each other, and that is what we will illustrate on the next slide. When we explore the rights and authorities of those involved in the legal person, we should, when we look at shareholders, distinguish between shareholders individual and as a collective. When the shareholders come together at the annual meeting of the legal person, they come together as the general meeting of shareholders. And the law is pretty explicit about the general meeting of shareholders by assigning all rights, which it does not assign to the management or others, to the general meeting of shareholders. So that's a pretty important body in the corporate game, and it explicitly states that the general meeting of shareholders has a right on being informed by the management. Now, if we first go to the individual shareholder, those have the right to attend the just named annual meeting, they can vote at the annual meeting, and they have a right on the profit which is distributed to them as dividend. Annually, there should at least be one general meeting of shareholders organized for the shareholders to attend. That GMS meeting has, of course, an agenda, and part of the agenda is that the board presents the annual account. We already saw that the board is responsible for a proper bookkeeping system, so when there is a proper bookkeeping system, that annual account can be drafted. That annual account explains, informs about the business results and provides an outlook for the future to the GMS. And we know, as already discussed a couple of times, that shareholders' liability is rather limited. The only loss they could run into is the loss of the value of their shares. Now, the general meeting of shareholders has also specific rights, and the core of the specific right is the right to vote on the general meeting. They vote on the topics which are on the agenda, one of them always being the annual account. There can be other issues to be voted on, like appointment, dismissal of board members, issuing of extra shares, etc. But the main right is to vote, and by voting to approve or disapprove, usually it's approving the annual account. That is for the management a fantastic moment, because we have seen that the management has a responsibility, is accountable towards the legal person. Now, at the general meeting of shareholders, the shareholders, on behalf of the legal person, relieve, discharge the management from its potential internal liability. So at that moment, the management can make a deep sigh of relief, because they know that by adoption of the annual account by the general meeting of shareholders, their risk of internal liability towards the legal person has gone. Another effect of the adoption of the annual account is that by adopting, the profit is established, and that profit is normally distributed as dividends to the shareholders. Now, can the shareholders influence the management by giving the management instructions? That is differently regulated for the BV and the NV. At the level of the NV, the instructions of the general meeting can only be general. At the BV, they could be more detailed, provided that the right to provide instructions is stated in the articles. And now there is one other issue to be brought in under this topic. For the NV, the law has created a specific right for the general meeting of shareholders. Normally speaking, the day-to-day operations and decisions of the management do not require approval of the general meeting of shareholders. However, the law says, and that is of course very broadly and openly formulated, if the board wants to take a decision which results in a major change in the character or identity of the NV, that decision must be submitted for approval to the general meeting of shareholders. The best example is a merger or a sale of the company. Those decisions are major decisions which would qualify for prior approval by the general meeting of shareholders. Here we see an example of such a major decision. Recently, October last year, Unilever decided to stop being a two-nationality legal person. They wanted to become completely British. And this move to the UK, this move to London as the article says, was submitted for approval to the shareholders, because under Dutch law it meant a substantial change in the character identity of the company. So as we just saw, it fitted under that article for the NV, the article which says that major changes must be submitted for approval to the general meeting of shareholders. When we move towards the management of a limited liability company, we run into some confusion, because management can refer to the act of managing and it can refer to the board of directors. That confusion is not completely avoidable, because it is management, the best possible translation of a Dutch word which better reflects what the management of a company is about, and that Dutch word is bestuur. Now the interesting question is, of course, what should and can this management, this board of directors, or this director do? So we make a distinction in a very brief overview between task, authorities and liabilities. The task of the management is, simply said, and the law does not have a better term for it, managing the enterprise. Now, managing the enterprise comes down to operational and strategic decision making, and in principle the management can take those decisions independently. However, and that makes corporate law pretty complicated, there may be limitations in the articles of the legal person or in the law, in statutes. We have seen the example of major resolutions like the sale or merger of a company, that those types of major resolutions, that type of decision making, is subject to approval by the general meeting of shareholders. What is the basic philosophy, the basic basis for acting? Decision making, strategic and operational, should always be in the interest of the enterprise. Now, the interest of the enterprise may conflict with instructions from the general meeting of shareholders. We've seen that there are differences at the level of the BV and the NV with respect to the instructions that are allowed. But if allowed instructions would conflict with the interests of the enterprise, the board must have the interests of the enterprise prevail. On the next slide, we will see some differences in the national company law systems. Now, in order to manage the enterprise, the board, the directors, the management must be able to act. And in order to act, to participate in business, they need the right to represent. So the legal person delegates authority to the management. One of the authorities which is delegated, the core authority, is the right to represent the company, which means acting legally on behalf of the company. And most relevant is that, of course, in the context of contracting, because by contracting with suppliers and with buyers, the directors manage the enterprise in the sense of managing costs, managing resources, and securing revenues for ultimately ending up with a profit which is to be distributed to the shareholders. Now, in principle, a board acts as a collective. Each board member is responsible for its own proper performance. However, if one board member performs improperly, all board members are liable for that towards the legal person. Unless, of course, that member of the management or that other member of the management board can invoke a legal excuse. Directors can be liable for more, but that is what we will discuss in the next slide on directors' liability. Here you have that overview of national company laws, and the complicated words used here are managerial insulation, but what you see is three groups, and in group 1 you see that the orange countries, the effect of shareholders on management is limited. We with the Netherlands are in the middle with, for example, France and Scandinavian countries. And group 3 assigns far more power. How that is done in detail, we don't know. We would have to look into the specific corporate laws of those blue countries, but apparently in the blue countries, the shareholders have a bigger say on what the management of a company is doing or should be doing. We looked at the management of a legal person, and we already noticed that the management must not act improper towards the legal person, because that may lead to liability towards the legal person. But as said at that moment, the whole issue of liability of directors is slightly broader than just the improper performance resulting in internal liability. When we talk about director's liability, we talk about a situation in which a director acted in his capacity as director, or the board acted in their capacity as board, but acted in such a way that the law attaches a consequence to it, and that consequence is that recourse for what they did, liability for what they did, can affect their private assets. So you must think of the situation that you are the director of a company, you do your work, but apparently the way you did your work can lead to a liability for which your personal private assets are available. Will that happen easily? Don't get shocked, it will not happen easily. We make a distinction between internal, that's what we discussed now a couple of times, towards a legal person, and external. Now, this improper performance is slightly extended. If the company would run bankrupt and your behavior is the cause of that bankruptcy, and we will see the complete article on the next slide, and there are insufficient assets available in the bankrupt estate, the company you manage, to pay the creditors, you, with your personal assets, may be held responsible for the amount that lacks. Now, if you do not have your accounts in order, if your bookkeeping system is improper, that signals that is considered a presumption of improper performance. If we go to the external liability, you must always realize that when your company is in financial problems, you must immediately notify the tax authority and the instances which collect premiums for the social securities, because if not, and it turns out that the company goes bankrupt and is unable to pay taxes and premiums, you may be held personally liable for it. You can also, as a director of a company, damage creditors or damage other third parties. For example, by selectively paying invoices and thus limiting the recourse opportunities for those which are not part of your selective payment. If anything you do in your capacity as a director can be seriously reproached to you personally, that could constitute an unlawful act and may lead to liability towards creditors or others damaged. The unlawful act is further detailed in Chapter 9. Rarely, but not impossible, a director of a company may be prosecuted for a criminal act. At the moment, the Dutch prosecutors are investigating whether the former CEO of the ING Bank, by not preventing money laundering through his bank, committed a crime for which he can be held responsible in court and for which he then, as a consequence, might be punished. We mentioned the bankruptcy article, and I just want to show you that article in some detail, because what it says, in the event of a bankruptcy, which applies to the public and private limited liability, here we see that each director can be held liable, and that is emphasized by the words jointly and severally. Jointly means the board of directors as a collective, and severally means each of the directors individually. For the amount of the debts, as far as these cannot be recovered from the assets of the legal person after liquidation, but then it becomes more complicated. It says if the board of directors has performed its duties clearly improperly, so that first must be assessed, and then the following, and it is likely that this is a major cause of the bankruptcy. So you see there are some hurdles, some thresholds, which are not impossible to be taken, but in practice, personal liability of directors is rather rare. Now, if the books are not kept properly, that is considered, that is assumed to be covered by clearly improper behavior, the same applies to not depositing timely the annual account with the Dutch Chamber of Commerce. Now, this may all make you a bit frightened, and you may think later on, I would like to become a CEO, I would like to become important, the first man or lady in a company, but if I look at all this, I am subject to all kinds of risk. Well, don't worry too much, because if you accept a CEO position or a board position, you and the lawyer which helps you in drafting the employment agreement will insist on a director's liability insurance, and there are sufficient number of companies offering that. The company will pay for that, and that insurance will ward off you having to pay for liabilities or debts or other financial problems of the company from your private funds. So don't worry too much, you can have an insurance against the risks we just mentioned. Two more to go in the corporate play. First of all, the Supervisory Board, and then we're going to finish with the Works Council. First, the Supervisory Board. Keep in mind that it is not mandatory to have a supervisory board. You can choose for it by establishing it, by including it in your articles, and it's only under Dutch law mandatory for the companies which are under the so-called large company regime. But what we see here is something which has to do with corporate governance. That's one of the final topics of this lecture. And we see here two types of boards. We see here ING having a separate supervisory board and Unilever not having a separate supervisory board. Separate meaning a supervisory board existing next to the management board. One tier, two tier, we'll discuss that under the heading of corporate governance. Now, what is this supervisory board about? I'll leave the first 3 points because they were more or less covered and the one tier is still to come. The supervisory board is appointed, suspended and dismissed just like the management by the general meeting of shareholders. The large company must have a supervisory board and the supervisory board can propose its own new supervisors. What are the tasks? Also openly defined in the law to supervise and advise, and also that, just like the management, must be performed within the context of the interest of the company. If we are talking about a holding, that interest of the company applies to the whole group if the enterprises in the group are connected to the part of the group which has the supervisory board. Now, the law is not very extensive on the task of the supervisory board, but that gap is filled by the CG, the Corporate Governance Code, which is in principle only applying to stock listed companies, but any other company having a supervisory board can of course use the Corporate Governance Code as a source of inspiration on how to deal with the supervisory board. Now, the Corporate Governance Code outlines what the main areas are on which the supervisory board should exercise its supervision, and that goes from strategy, risk and control to the relationship with shareholders and all kinds of other so-called societal aspects. Now, the final player in the corporate play, the final player on the stage, the Works Council. In the Netherlands, we have a Works Council Act, of which the basis is that employees should be given the opportunity to contribute to decision making. That is not always, as you see by the face of the director, appreciated by the director, because it creates for the director sometimes, as we will see, a hurdle or even an impossibility for his decision making. Now, as said, the basis of the Works Council, the basis of employee representation in the Netherlands is the Works Council Act. The Works Council Act imposes on the entrepreneur, that is a natural or legal person which runs a business in an enterprise, to establish a Works Council if the enterprise has 50 or more employees. The Works Council is the result of elections. If the entrepreneur would have more enterprises, then in principle the other enterprise, which has less than 50 employees, need not have a Works Council established. But if the situation is that both enterprises are in what way connected, the law allows to have one Works Council for both of the enterprises because they are connected. Why is this director looking a bit sour? The reason is that the Works Council has authorities and they may conflict with the speed with which a director wants to have decisions implemented, or they may conflict with the content of what the director wants to implement. Now, the first three are rather general. The Works Council can take the initiative to discuss the course of the company. Regularly, they should have consultation meetings, and the Works Council is entitled to information. Now we get the two most important rights. The Works Council can advise on important resolutions, and for new policies, employee-related policies, they should give consent. When you think about important resolutions, you can think about selling parts of the company or obtaining substantial finance. Those are all kinds of important resolutions on which the Works Council should be given the right to advise. It can happen that the director is not happy with the advice and decides to deviate from it. That would give, if they want, the Works Council the right to make an appeal at the Enterprise Chamber and ask the Enterprise Chamber to impose on the entrepreneur the obligation to take the advice into account in its decision making. What can also happen is that the entrepreneur takes a decision without having the approval of the Works Council. That, in principle, makes that resolution, that decision, void. It can be overturned by the entrepreneur, and for doing so, he has to go to the Continental Court. When we are talking about a public limited, an NV, the Works Council has some extra rights, which I will simply leave as they are on this slide, and it would become too detailed. The fifth right we saw in the list on the previous slide was the right to make recommendations on changes in the board. Now, this is a bit of a row between the Works Council of Tata Steel and the entrepreneur. The entrepreneur makes the statement that the CEO departed voluntarily, and as that is the case, it need not have sought the advice of the Works Council. The Works Council disagreed with that and wants to have a say on it. They want to be consulted about this departure, and this resulted in a spontaneous blockade by staff, a spontaneous strike by the employees to underline the fact that the course of action taken by Tata Steel by making a change at the level of the board was not implemented according to the rules of the Dutch Works Council Act. We have looked at public and private limited liability companies, at corporations, as it being a play in which we have various actors. Of course, you cannot expect the law to be so detailed that all interactions between these actors and all decisions which these actors take are regulated in detail. That is a gap, and in practice, that gap is, at least for listed companies, but other companies can also take inspiration from it, filled by a so-called corporate governance code. Drawn up by private parties, directors of companies, it tries to fill the gap which results from the fact that the law is not so detailed. It tries to provide rules, best practices and principles which the management board, the supervisory board and the company shareholders can use to structure their relationships. The Dutch Corporate Governance Code also takes an interesting perspective on what a company is supposed to do. In other words, what in principle the management, but also supervisory board and shareholders are supposed to be involved in, and that is long-term value creation. So within the Dutch Corporate Governance Code, the sole aim of a company is not just to provide as much return as possible to shareholders, but the core activity of a corporation, of a company, is to create long-term value. Now, when we talk about corporate governance, and you already sensed it, I think, when we look at how corporate governance is regulated, we can distinguish two approaches. A jurisdiction, a country, can decide to create rules, make legislation, and include penalties, like we see in the USA. But in the Netherlands, corporate governance is principles-based. We have a privately developed corporate governance code, which contains the best practices and the best principles from which to structure interactions between the parties involved. And the overarching principle with respect to accountability is the comply or explain principle. So in principles-based regulation of corporate governance, the idea is that a company should apply the best principles, practices, rules from the corporate governance code, and if they do not, they should explain why in their specific situation they have chosen not to apply it. The Dutch corporate governance code fits in that principle-based tradition and contains that comply or explain rule. The European Union also takes the principle-based approach, and it indicates that in annual corporate governance statements, the company should explain why or why not they follow the rules of their corporate governance code. And the EU also makes a strong statement in the sense that it expects companies to report on both financial but also on non-financial information. Now, we have talked about the management and the management board, and very briefly the words one-tier and two-tier were mentioned. The situation we have in the Netherlands is that we have different board structures. So jurisdictions think differently about the board structures which a company should have or can have. Basically, the two possibilities are the one-tier board or the two-tier board. I like to say to you that in the grey countries, which the Netherlands is, both are possible. In a one-tier board, there is one single board in which we have directors, but they have either an executive role or a non-executive role. Executive directors run the company on a daily basis. Non-executive directors focus their activities on strategy development. When we have a two-tier system, we have two separate boards. One is the management board, and the other is, as discussed, a separate supervisory board which supervises and advises the management. Now, you can see in Europe that there are differences in the jurisdictions. 1, 2, both, or sometimes even more board structures are possible. Now, if we would look at the legal traditions, the big legal families, we can identify 3 generic corporate governance models. The differences result from the differences in decision making, who makes the decision, what is the prevailing interest, and to what is the accountability arranged. We distinguish 3: managed corporation, socially responsible, responsive corporation, and Islamic governance. When we talk about the management corporation, we have a board with executive directors and non-executive directors. This is basically the Anglo-Saxon model. in which a company exists for the sole purpose of satisfying the interest of shareholders, and the company is accountable towards capital suppliers. That includes shareholders, but can also include other suppliers of capital. When we talk about the European Continental model, we call it a socially responsive model. We have a board and separately a supervisory board. The prevailing interest is not the interest of stakeholders, but broadly speaking, the interest of all involved, which we summarize as stakeholders, and the company is having a responsibility towards society. Islamic governance, you also have a board and you also have a supervisory board, but the peculiar thing from our perspective is that that board may be a Sharia board in which religious scholars supervise and advise the company. The prevailing interest is broad society and all other stakeholders, and the company considers itself accountable towards society, all of its stakeholders, and also towards its religion. So now we have reached the end of the lecture, and we're going to integrate it with a focus on your future role, and that is, if you do well, managerial decision making. In this integration, we, as often done before, we look at it from an internal and an external perspective. But first, we integrate what we have been discussing in a model which depicts, visualizes the steps in creating a business. You are an entrepreneur or a company and you have a good business idea or a concept. Hopefully you have learned that you first investigate whether you can protect your idea or concept by having intellectual property rights established on it or automatically granted to you. You must secure financing, of course. Once that is done, you may choose to start operating, and then you need what we discussed, a legal form. That includes a trade name, a name for the company. You choose a legal form, realizing that the choice has effects. Effects with respect to, for example, liability, and effects in other areas. Then the management starts operating, and part of that operating is contracting. Now, if you have a legal person, you have the right of representation, so you have the capacity to bind the legal person. On the other hand, you should also realize that contracting may lead to liabilities for your company, and under rare exceptional circumstances maybe also in a personal liability. Hopefully everything goes well and you realize profit, which are taxed. And the final question is, to whom will the profits go? Those are the steps in creating a business which you might consider to go through in the future. And then the final slide tries to illustrate something to you, and that is the following. When you read business books, marketing books, corporate strategy books, you get the impression that when you are a CEO or a manager of a company, that you have a lot of options in doing your business. In other words, that you have a large amount of freedom in running your business. I want to fine-tune that image a bit in the following sense, that both internally and externally there are limitations on your decision making, and they come from various sources. For example, internally you are limited by the objectives which you have to realize, the resources which you have at your disposal, and then from a legal perspective, specifically by what is in the articles and specifically what is described as the object of the company, because the object of the company denotes the limitations, denotes the field in which you as a director can operate. Now, corporate culture you will understand, but we saw that there might be a supervisory board looking into what you are doing and advising you. There might be a works council. Once a year you have the general meeting of shareholders. There will be elements in your employment contract you must take into account, and your employment contract will probably make the company's code of conduct, or conducts in plural, applicable on you. So those are all kinds of limitations. Well, you will not be surprised that outside of you in the regulatory environment there are also limitations like legislation, decisions in case law, supervisory authorities, soft law which you actually should follow. We have seen the corporate governance code. You know that you have shareholders, and the trade unions may also play a role. So what actually is the message? Business books, marketing books, strategy books may give you a picture of paradise, dynamically running your business, taking decisions which will make the company grow. But as usual, when the lawyers come in, the party is destroyed a bit. If you look at this last slide, you will come to the conclusion that your managerial decision making is subject to many influences, and for many a decision you will, if you are a CEO or a member of a board, it is unavoidable, have to consult your lawyers in the company or an external law firm to make sure that you can take the decision and to make sure that you will not be liable for your decisions. So to conclude, if you reach the level of a CEO of a company, you will find a good friend in the company, and that is the general counsel or the lawyer of a company. And you are automatically driven into each other's hands. You will need to become friends, which is a bit of a challenge if you want to become friends with a lawyer, but at the level of the CEO, it is fairly well possible, I would say. So, greetings from a friend. This lecture on Chapter 7 Legal Forms has now ended, and I look forward to see you in the following lectures on the resulting chapters 8, 9 and 10. Thank you. Bye bye.